Welcome everyone to Add More Markets. My name is Chris. Naneth is with us here today as well. We both are going to show you why classical technical analysis is so interesting, so good to learn, and so profitable as well for especially the long term. And we welcome you to this webinar. First of all, before we start the topic though, we do have an important message to discuss with you regarding the risk disclaimer. We have a high risk investment warning that we want to present to you. First of all, actually, a disclaimer regarding the fact that this material here, this webinar is intended for a global audience. Please take into account that the session may not be suitable for everyone. To find out and get more info on charting conditions and other details, please visit addmoremarketsglobal.com, select your country residence, and contact the appropriate entity. Then indeed, what I wanted to say at first, that the fact that this is, of course, a very high-risk business. Trading for exchange and global financial markets are considered high risk, and they may not be suitable for all investors and traders. Please seek the advice of an independent financial advisor for more information on that. This webinar is for educational and informational purposes only, and by continuing watching this webinar, you agree with the disclaimer mentioned here and on the addmoremarketsglobal.com website. Alrighty. Thank you for your attention. I see we have a good number of people here. I'm not surprised. It's a great topic. Who doesn't love technical analysis? Let's face it. It's a beautiful field. I just find it fascinating. It's just gives a lot of creativity, I think, a lot of visual aspects to it. So I think it's just really a lot of interesting things one can find in technical analysis. I think it's really very valid to learn and to develop in this field of topic. And we can use it, of course, not only for Forex, but you can use it for all kind of financial products and markets. But obviously, this webinar is going to be focusing on Forex. We're going to talk about here, I don't have an agenda, okay. Well, anyhow, it'll be a multi-layer approach to Forex trading. First of all, by the way, I'm going to be talking later on, and that's going to present his part. You can have basically a multi-layer approach to Forex trading, right? You could, for instance, first layer, you can think about is a single or multiple strategies. At the beginning, a trader would probably opt for using a single strategy and then might work towards multiple strategies. One could look at single or multiple pairs, and even single and multiple entries on one pair. And you could have, of course, a pretty vast network of how to approach the trading and how to approach with a portfolio of various elements. So, for instance, you can have a breakout strategy with a fib strategy, and you can trade the euro-dollar, the pound-dollar, and the dollar-yen, and you could be trading 3 fibs, for instance. So you quickly expand into things that are more complicated. Whereas, of course, if you trade one strategy on one pair and you trade only one entry at a time, things are more simpler, which is not always bad, by the way, but it depends on what a trader is used to and what a trader can handle at any point of their learning curve. All right. Most traders, though, eventually do branch out a bit to increase opportunity and to reduce maybe screening time. Now, focus of each strategy could be, for instance, on the time frame. You could be using multiple time frames, and it could be discretionary versus non-discretionary. These are various things that traders use to identify a strategy, right? You can, for instance, use a 4-hour and a daily chart and trade long-term, and you could start to use multiple tools and indicators to make a discretionary trading plan. For instance, that's one way of tackling the market. For instance, here is a very reasonably automated way of trading it. You're looking for indicators to line up in a certain way, and you see the candle that matches or confirms the breakout, for instance. This is a very automated way, a high level of automation for this particular strategy. Now, why am I talking about strategies? You might wonder, this webinar is about technical analysis. Well, my point is that automated strategies, right, no matter basically no matter what strategies, basically, automated, non-discretionary strategies that are a mix of the two strategies that have a lot of indicators, no indicators, price action oriented. At all these times, they could be great, they could be very profitable, they could do tremendously well for our accounts, and we can feel top of the world. But at some point, they could have drawdowns, they could be less profitable, they could offer less opportunities. And if we're dependent as traders on one particular strategy or two strategies, that might have the disadvantage that we are not able to adapt our trading business, basically in general, which incorporates strategy or strategies, to incorporate that into, to adapt ourselves to the new environment, basically. But if you are able to understand the market, if you're able to understand the market structure, if you're able to use technical analysis, then you're not dependent on that breaking or failing or having a slump, because you can use those tools to understand what's going on with the market structure, and you can spot then various ways of adapting your trading business to that new environment. That's why technical analysis is important, because it's the basis of all strategies. It's the primary way, well, not all, but you have news trading and fundamental strategies too, but it's a very important to be a master, to be good in technical analysis, so that one could become a great trader and also generate and create great strategies. A great technical analyst doesn't necessarily mean a great trader. No. But a great trader is often pretty good at technical analysis. All right? So it boils down to the fact that technical analysis is useful in any case. It's not everything, right? Just because someone is a great technical analysis doesn't make them the best trader in the world. No. Because trading is more than that. Trading is about risk management. It's about willingness to take risk. It's about trading psychology, money management, right? But very important stuff. So how can we use technical analysis? For strategy creation, for being less dependent on one strategy, for ability to optimize strategy, and for understanding the market structure better. So I think we discussed most of these points already, so we can move on. But creating strategies, basically, less dependency, optimizing and understanding the market structure better. So now we can finally dive into the usage of technical analysis, right? The strategy and plan lead to the consistent profitability. Without doubt, that's what we have to be aware of. I'm not saying that strategy is bad. I'm not saying trading plan is bad. They're the ones that lead to the profitability. But as I said, the technical analysis is the base for getting to the spot where you can make good strategies and trading plans. We also can create and use filters better and understand why a strategy has a slump. So these are, again, more reasons why technical analysis are good things. All right? So what things are considered technical analysis? We can use trend, candlestick patterns, chart patterns, right, are very key elements to technical analysis in understanding what's going on with the market and the market psychology of the particular product we're looking at or pair, right? This provides a ton of information, and it's up to us to understand the communication that the market is providing to us at any point in time. But whether we understand it with a lot of accuracy or if we fail to understand it with accuracy all depends on our strategy and plan, but also on our understanding of technical analysis. It's like a foreign language, and slowly but surely a foreign language you start to understand more and more, and the loss in translation decreases. That is the same for technical analysis, but we have to put the same efforts into learning it as people do with languages, because it requires dedication, it requires daily, almost I mean, the more daily routine you make out of it, the better. Let me say it this way. Trend lines, trend channels, moving averages, oscillators, fibs are all tools and indicators that are very classical, with technical analysis. Technical analysis is very wide. There could be all kinds of things connected to it. There could be tools and indicators used by traders that I've never even heard of, that are proprietary, that are old, that are new. There are a ton of them. These are, I would say, what I consider classical ones because they've been tested, they've been used by generations, in fact, and most of us know what they are. So now we're going to talk about step-by-step way of how you can use technical analysis. All right. What I would suggest, the very first step, and if you want to write them down, maybe it could be good, is candle of a higher time frame. I think that's a good way to start. First of all, step one, check a higher time frame candle, like the daily or weekly. Why do that? Because it gives a lot of sentiment. It gives a lot of understanding what the direction is of the market. If we have a strong bearish daily candle, a daily candle with the difference between a high and a low, which is substantial, for instance 200 pips, right? A clear bullish candle or bearish candle, that's control. But how much control? All right, a small candle would have less information, right? A big candle means a lot. How much control is important too, because if the close is near the high or the close is near the low, that will signal strength. The bears and bulls are in control. But if there's a lot of wick, if half of the candle is wick, does that show a lot of control? No. That shows that maybe the bears lost control or the bulls lost control throughout the day. That wick shows signs of bounce. So just looking at that candle, where is the daily high and low or the weekly high and low? It all depends on what time frames you're trading. If you're trading on the hourly or 15-minute chart, the weekly high and low is probably less important, for instance. I like to start with this as step one. Now, I'll be honest with you, I mix these steps personally. But if I had to give a sequence to it, I think this is the ultimate great point to start with. Look at this daily candle on the euro dollar. That happened last week Friday with the euro interest decrease. It was a massive 240 pip day, and the close was maybe 20 pips off the low, within 10%, I think, or maybe within 5% even. So basically, signaling a lot of power, that daily candle. That's very valuable information. That's my step one. Let's see. Viganta says we don't need to write it down. It can be done by on top right corner with the camera. You see, technology is a lot more advanced than I can keep up with apparently. So that's good to know. So step two, what is the most important? I think swing and trend. What do I mean with swing is basically momentum 2A basically. Swing is momentum or correction. Is the swing high and swing low we're looking at, does it have a lot of momentum or is there a correction? And what is the overall bigger trend? Now that might, if you're maybe new to trading, that might seem very similar. What is the difference between those two? What is the difference between momentum and trend? So let's take a look at an example. Basically, when you look at this chart, you see perhaps a downtrend, right? For instance, because you can see momentum, you can see lower lows and lower highs, right? Like a channel like that. This is a trend. This is a downtrend. But within that downtrend, price can move up and down. The difference is that the downside will most likely have more power and more lengthier moves because the overall slant is to the downside. But it doesn't exclude that at some points price could be moving with impulse to the upside. Impulse, however, or momentum, is the part where price moves fast in one direction. These are momentum parts. These are momentum, down momentums within a downtrend channel. This is momentum to the upside within a downtrend channel. So it's a downtrend, but at times we have up momentum, at times we have down momentum. That's the difference. If you have any questions, by all means, please let me know. By the way, if this is not clear, I gladly answer any questions in between. So this is step 2. Once we've looked at the daily candle or the weekly candle or both, I suggest when tackling the technical analysis to look at the trend and swing. Put channels on. Identify what the momentum is. And then we can move on to look at the next step of the puzzle, right? That's what we're trying to put together, basically. In a way, we're like puzzle makers, or we're like detectives. And we're half detective, half roadmap readers in a way, because the detective is kind of the person who does the analysis, and the roadmap reader is the one who executes, who implements the trading plan. So step 3, I think, is important: patterns. Now you can twist and debate whether this should be step 2, but not too important, I think. But I think patterns are very important. We got candlestick patterns and chart patterns. I think that these two provide the structure of the market, provide an idea about what we could expect after the pattern. So patterns are great moments to kind of like read the market, put the finger on the pulse, and say, okay, it's probably going to do this or this. Right? So let's take a look at an example. Here, for instance, we see a euro-dollar 1-hour chart, and these blue lines indicate patterns. All of these are bear flags, by the way, and they're great tools or patterns or concepts, sorry, I should say, to identify what could happen next. When you get impulse, for instance, to the downside, right? Let's say we have a bearish daily candle here. Okay, then we see the impulse to the downside, and we see the downtrend. We see flags like this. So A, we have information about bearish daily candles. B, we see downswing, we see down momentum, we see downtrend, and we see channels that look like bear flags and our chart patterns, right? Well, this is already a very valuable, scenario that we're building here, aren't we? And then we see on top of that some some candlestick patterns. A shooting star here, engulfing twins here, engulfing twins here, engulfing twins here. So that's the cherry on the cake. So when that happens, we can see what occasionally does happen, right? The break of the bear flag. Not always, as you can notice, I said not always, because not everything is 100% in trading, right? But the chart patterns do provide enough information, in my opinion, that they provide an edge for us to use them. So these are great things. I got a question: what causes the downward trends or momentum? It all boils down to the supply and demand and the psychology of that between these two currencies, and how the trading community responds to that. So we got trading community that respond to all kinds of things, fundamental news, technicals, news events, and they respond in different ways, but eventually there's going to be supply and demand for currency, whatever the reason. In my opinion, it has to do with market psychology. Not everyone would agree, but I think it's the market psychology that makes the market extend further than is rational, and that's why traders can capitalize on those overextensions. If everything were to be rational, there would probably be not much profit potential available. But because there are emotions with trading, because there are emotions with traders, and because there are emotions, because traders have emotions, the market has emotions, I think it's the market psychology that makes these up and downs so much. So here's another example of a contracting wedge, where we see an A, B, C, D, E, a classical contracting wedge, and it provides information about that. We can see, for instance, here that there was a down impulse, and when we get some wedge like that, that doesn't break the top of this swing high, swing low, the top of that, then we can see we get the follow through to the downside. Very important to support and resistance, right? All kind of levels we could think about. Their support and resistance topic is quite vast in how you can use it, in my opinion. There are many tools and concepts a trader could use. The most obvious ones are tops and bottoms, broken tops and bottoms that have the opposite effect. Zones, like previous chart patterns, supply and demand, which are basically, supply and demand zones are basically tight ranges that have, for instance, here an impulse range followed by an impulse again. This in the middle becomes kind of a supply and demand zone. Fractals, an indicator of Bill Williams that easily indicates the tops and bottoms, 2 candles to the left and 2 candles to the right. For instance, here we have 1 candle, a second candle. This candle high is higher than 2 candles to the left and 2 candles to the right. It's a fractal. And Fibonacci. You got many more, no doubt. Here's an example of your dollar. This is a key level. These key levels here, price couldn't break through it. Support, stopping price from continuing in this downtrend. Double bottom, price stopping, the bottom stopping price and reversing back to the upside. Was in a bearish momentum, bearish downside, but you can see that looking at where support and resistance is very important, because although we can have momentum, although we can have a trend, although we can have strong candles, although we can have chart patterns, if we don't know where support and resistance is, we could face ugly surprises now and then, right? Then I would say step 5, in my opinion, it's kind of like a general term charting. These could be static indicators or dynamic indicators. Static indicators are ones that don't change. Fibonacci doesn't change. Pivot points do not change. Well, with the new trading day, but during the trading day. Dynamic ones are ones that have some change in them, like moving average, like trend lines. I see I have pivot points there twice. Sorry about that. Those are dynamic. Moving average changes each bar. This is what I consider charting. So you've done your homework now, right? With step 1, 2, 3, and 4. Now you're going to look for clues that provide extra structure to the analysis. What trend lines do we have? What trend lines and angles are relevant? What kind of moving averages can we put on, like for instance the 34? How far is price from moving averages on all these time frames? Is price going back to one of those moving averages? Is it moving away from them again after a retracement? All of that is useful information about where price is reacting to the average on multiple time frames. And that's so important to understand the psychology of that particular pair better. Why? Because if price if moving averages are at a steep angle, it shows the psychology of the market. If they're flat, it shows that the market isn't moving anywhere. It's very important for reading the psychology of the market. And then we have last but not least the oscillator. Here's an example of, for instance, the pound New Zealand hourly, and you can see static indicators, right? Pivot points, Camarilla, price bouncing off of these pivot points with an intraday trading for upside. This gives structure to our analysis. Fibs, identifying swing highs, swing lows, then we can use the fibs to place a fib on it and identify turning spots for more upside at the 61.8 and the minus 61.8 targets, or to look for reversals back to those levels, which is more dangerous. Trend channels and trend lines within an uptrend here. You can see moving averages providing information about the psychology. When the moving average is here, I don't know what this is, probably 34, and this is a 144. When the 34 is being pulled away from the 144, and the gap is ever increasing, what does that say about the market psychology? Momentum, a lot of power. When moving averages are being pulled back towards the other set of moving averages, means consolidation, means pause, like it's happening right here in the middle. So very valuable and very intuitive, very easy, very nice to see. Simple, makes charts instantly understandable without really putting too much headache and effort into analyzing it. Wonderful tool. So then we got the oscillators. We can use part of the tradition, like say charting features. One, you can use an oscillator or multiple oscillators, like an awesome oscillator, which I use, or a MACD like Nenet uses, or an RSI as some others use. This basically helps us with identifying the more hidden element maybe of price action and structure. Whereas at face value, for instance, a trend could seem strong. The oscillator and its reading could help us understand that the trend and the momentum is maybe not as strong as we think. Here, for instance, we see at the bottom that there's divergence between the bottoms. That means price is making a new lower low, making lower lows, but the oscillator isn't. And that typically means that a trader should be careful and cautious about that direction because it's not being supported by the oscillators. So it's a very useful concept to add to the analysis because it provides an extra nudge of confidence when certain pairs could be reversing, when certain pairs could be trending. Here, for instance, upon the break of this trend line, we see no divergence. Here neither. Those are very good breaks because look at the moving averages, they're bearish. Look at the impulse, it's bearish. Can't say anything about the trend, in fact, but those two things are very bearish. The AO is very strong, very bearish, no divergence. So when you break, for instance, here, these support lines that indicate smaller bear flags, you got a classical breakout, and you can, there's a way of capitalizing on the structure of the market and the pips that these setups could be providing. So those are ways of how to analyze it. Now the last example here, you can see we're already getting divergence between the bottoms, and this last break doesn't go as far maybe as the others, although it's probably sufficient to get some mileage out of it, right? So let me recap my side of things here to put it all in perspective. Quickly, only the steps, of course. Yeah. So once again, I would start with the candle, look who's in control, then dive into the swing high and swing low, look at momentum or in correction, look at what the trend is. Trend channels, trend lines are here, the motto, I would say, but doesn't have to be. You can save it for step 5 too. Then looking for chart patterns, for instance. Candlestick patterns, chart patterns. Then looking for support or resistance, tops, bottoms, broken tops, fractals, right? Then charting, moving averages, pivot points, Fibonacci, and then the oscillator. So I'm going to grab a chart here, and we're going to take a look just quickly here, a few minutes still, to look at a real-life example, or a past example, I don't know, we'll see. So we take it step by step, look at it at a real example, sort of, we reinforce, make a look at something that maybe is now, and then I'll pass it over to Nenet, and he can give his take on technical analysis. So which pair would you like to see? Anyone have a preference pair? I don't mind. I mean, don't choose versus Indian, what's it called? Not rupee, or Russian ruble, or rupee, isn't it rupee? Yeah, I think so. USD, good. Gigantes, you were just a split second behind. Maybe we can fit in a GU, let's see. All right, USD. Indian ruble? I thought it was rupee, but maybe I'm wrong. Yes. Yeah, I was talking about the Indian. No, it's the Russian ruble indeed. Sorry about that misunderstanding. So let's start. Start with the daily chart. Step 1, look at the daily candle. Bearish yesterday, right? Although a bit of wick. But overall, you can see, though, that, well, that's step 1. But step 2, overall, we can see that the momentum is bearish, right? Bearish momentum. Very clear fall. Bears are in control. Strong fall. So a lot of bearish momentum. How about the trend? Well, to be honest, on the 4-hour chart, there's no trend. I mean, depends which chart you want to use a trend. I mean, I think 4-hour chart is the best. There's no trend. Why? Because we need some kind of angle of a trend channel to have a trend. I mean, there is a trend. I mean, there's a momentum. There's a bearish momentum. That's what I mean. A trend is something like this that has an angle. But obviously, we do have a lot of bearish momentum. So maybe no trend. Eventually, we could see retracement to get an angle like this. For the moment, we don't have that. What we do have is a chart pattern that was broken, right? Because we got a consolidation zone that is going sideways like this. So that we do have. So we don't have a trend. We did actually have a correction, and that is being broken. So when we look at the daily and 4-hour chart, we see A, bearish daily candle, B, bearish momentum on the 4-hour chart and the hourly. We see no trend. We see actually a breakout of the consolidation happening. And in that regard, we can reanalyze yesterday's daily candle and say, okay, yesterday's candle was a breakout candle. So in that regard, that bit of a wick I don't think is too important. If it was really a reversal, I would have been a bigger pin bar. All right. Now, this is also what I said today in today's trading room, by the way. So the fact that indeed price went up and now down is not the reason why I'm saying it. For those that were in our trading room today, know that I said the same thing this morning, in fact. Okay. So that's the first 3 steps. Chart patterns, candlestick patterns still. Not now, but we did have at the top kind of like an engulfing twin, then right here, but not now. So that's chart patterns and patterns. What was this? Step 4? Did I miss something? Yeah, support and resistance, of course. Well, basically support was broken. We got support and resistance, clear boundaries, because that lasted 5 months. So other levels of support, we can look at the weekly chart and add, for instance, levels like this to the chart. We can see there's a lot of space to fall potentially here on the odd USD. On the daily chart, we can have maybe minor levels here, here to be aware of, but those are on the daily chart. You can even draw a different color to show that they're less importance, for instance, like this. Now that's not all. Obviously, you can even zoom in lower and find lower support resistance, but these are the most important from a higher time frame perspective. You have to find a balance not to put tons of support resistance on all of charts, otherwise, there would be too much basically. But then we could do some charting. Let's take a look at, and charting basically, I would tend to do on a lower time frame, like an hourly chart, look at the pivot points. And as this morning, we saw already the bounce off of this broken consolidation. We talked about the fact that 92 is the consolidation zone bottom, and that the price could hook back to that bottom. That bottom, basically not only a bottom, but also a 38.2 fib. And in that, indeed, proving to be the downside reversal spot, as we can see, for at least some pips. So a lot of good stuff there. Now we're breaking and continuing. Just to provide you an example here, on the 50-minute chart, I said this morning that a break below this particular fractal would be a good breakout trade. And that's what's happening. We got an L3, a fractal support close to L3. We had a break of this trend line right here. We had price bouncing off resistance, so some follow through is possible. So we can conclude that basically a potential breakout was possible here. And price did push through for some pips. How much? The max it went down was about 50. How much a trader gets out of that is another story, but obviously there's plenty of space to catch a decent profitability in most cases. If not, then if someone's still in that trade, you can easily click out now, right here, right now, for 36, 35 pips probably. So not a bad trade. And this is how we came to that conclusion. No divergence on the hourly. I forgot to mention the oscillator, 4 hour, no divergence in the 4 hour. Regarding the oscillator, so this is how we made and tackled basically, we made a trading plan for that point in time. How about now, you might be wondering? Well, now there is divergence on the 50-minute world. Price action is slowing down on the 15, plus we've entered New York lunchtime. So now is not a good point in time to, I would say, be looking for trades. But if it does hook back to the daily pivot point, obviously it still remains potential resistance here in this zone. That could still be providing a good resistance spot for more downside. We could see some retracement of the 4 hour candle as well. So anywhere around 91.50 could be a good hook back for more downside. That's how I would look at it at the moment. Although we have to be careful how price responds to this divergence. If price starts to move up very aggressively, we need to be cautious. I would stay out of it. If price spikes up to 91.50 or moves up to 91.50 and we see some shooting star rejection, that would be a confirmation of more of what I'm looking for. That's how I would say is the best or the best thing to look for now. One could even consider a breakout still below the L4, by the way. It's possible with the target of L5. That could maybe happen in Asian session later today or after New York lunch, could happen. However, I do, from my point of view, I was looking in any case for a breakout below 91.50. For me to start shorting it and below 91 this later today is time-wise doesn't make sense because anyhow it's my end of the trading day, but it doesn't make sense because the short 50 pips higher is what the one I was looking for. I mean, if I let go of that, then the L4 is still typically a breakout level one could think of, right? This is how you can use the tactics to still capitalize on the fact that the 4 hour is in bearish momentum, that the hourly is in the bearish momentum, and that the daily is breaking out of consolidation zone for downside. Now, obviously, when doing analysis, the analysis could be perfectly fine. The analysis could be spot on, could be 100% correct, but a trade setup could always be a loss. So that wraps up my side of things. I'm going to pass it over to Nana. If you have any questions, of course, we can still take a look at that later on. So let me see if Nana, please pass it on to Nana.
Great. Thank you, Chris. Excellent presentation. Yeah, so guys, Chris have already told you a lot about technical analysis and why it's important. I will tell you my views why for me technical analysis is, I can say, 70% more important than fundamental analysis. And one thing is for sure, if technical analysis is in agreement with fundamental analysis, that is usually a certain win. But usually when fundamental analysis is in contrary with technical analysis, then still again technical analysis will win. To be honest, many times it happened that fundamental analysis tells you otherwise, but technical analysis just tells you different story. Australian dollar is example today. You saw how big unemployment. I just don't want to go into that. Why is it so big? The figures which happened last night were 10 times the forecast. Still, Aussie has dropped like a rock. It didn't drop, it didn't retrace. It dropped like a rock. So basically, technical analysis was saying, yeah, go short it. But fundamental analysis, okay, it's already low. Try to long it at support. Longing it, as we could see, around support, which was around 9120, 30, was not so good. So basically, again, technical analysis, in my opinion, works. And in my opinion, it just is vastly superior to fundamental analysis, especially if you're day traders. If you're day traders, stick to technical analysis. So the first thing which I would like to tell you about it is, I will be fast with this because we have still some 20 more minutes to go. The thing is, technical analysis is a methodology of forecasting price action direction through the study of historical price data. Old school technical analysis is based on candlesticks and chart patterns. I can say that I am a little bit of an old school trader. Modern technical analysis uses a number of indicators such as RSI, Bollinger Bands, MAs, and so on. Mostly modern technical analysis is it's done on indicator templates. You can see RSI, you can see CCI, some of those indicators which can tell you the direction. Many guys do that. I personally, as you know, I'm a fan of pure price action and MACD, of course. Because MACD, I use MACD for spotting the momentum and for spotting divergence. Divergence in my trading is important, but also important is the confluence of my technical analyst tools. I don't know if other traders or other well-known names in Forex do that, but I personally favor confluence points. And that is why I make those POCs, points of confluence. Those are buffer zones, usually 10 pip buffer zones, where we can take an entry. As you can see, GBP Swissy, unfortunately, my GBP Swissy was set at 51.55 pending order. POC was also 51.60. Well, I missed it for 3 pips, unfortunately. But the guys who are in the profit. As you can see from GBP Swissy analysis, which I did today. So technical analysis wins over fundamental analysis, at least on my account. The thing is about technical analysis that modern and that old school approach, both are good if you know how to read the charts. There are also successful traders who indeed can read the chart, but they just do not have the good approach. If they have a good approach with the tools they have been using, then their technical analysis will be correct. So usually technical analysis stands in contrast to fundamental analysis. It stands in contrast to fundamental analysis. So guys, always pay attention to proper reading of the chart. Now, Characteristics are those. It's in contrast to fundamental analysis usually and very often used by day traders. Its study suggests the historical behavior of the price. Now remember this, guys. For proper trading, this is the crucial thing. Now, if you know why I don't believe in expert advisors, one of things what expert advisors just cannot see is the historical behavior of price. You need a human mind to read through historical behavior of the price at the exact level, and because of that, most of my entries are 80% correct. Historical behavior of the price, if I go with retracement trades, breakout and scalps are different things. I'm strictly talking now about retracement trades. Historical behavior of price in classical technical analysis and in classical Forex trading is crucial. This is my favorite part of technical analysis. Historical behavior of the price. Near term and historical buyers and sellers or sellers. All information is already reflected in the market's price because the history repeats and the history will repeat itself. In Forex, use of technical analysis is more widespread than fundamental analysis, especially for day traders. Again, technical is suburb compared to fundamental analysis, but the problem itself lies in interventions and various news releases. Again, look at Aussie movement today. Even though the figures were great, what happened is price went down. Price went down. So the thing is, guys, never ever forget the importance of having a good technical analysis in front of your desk and in front of your screens. Price moves in trends. That's normal. So history repeats itself. You can go with backtesting. How to solve conflicts between technical analysis and fundamental analysis? Intraday analysis should always be made prior to any potential trade in the market. Get to know the pair which you will trade. Always check your calendar first for any red news. Unexpected events such as central bank interventions and natural disasters cannot be controlled nor predicted. It's the risk, guys, which you need to take on. Always respect and follow your charts. Don't trade 30 minutes or 50 minutes prior to big news. Unusual spike in the price is probably led by some news release or rumor. The price tends to correct it afterwards. Use fundamental analysis as guidance. As I say, if fundamental analysis is in agreement with technical analysis, you will get the better price. Fundamental analysis misleads technical traders by spiking the price. Always believe your charts and don't trade on bid rate days prior to NFP stress tests, Fed or ECB conferences. How I do the technical analysis? I usually wake up prior to London Open. Either I do the analysis or I wait confirmation 1 hour after London opens up. You see, sometimes I don't come up straightly with analysis, but when I spot a good setup. Again, let me pause the screen for a brief second and show you something to see. This is what I did today. And if you were paying attention to this, this is what I was waiting for. So, guys, when you see such price action such as this, basically what you need is to be patient. You need to be patient. Let me see if I can actually come to my blog and open the full. So those, I can do this like this. Look at this. I did the analysis. I was patiently waiting for analysis, and when price was around 58, 51.80. I finished the analysis, and the price just hit this POC here. It just hit this price, look, and went straight upward. Now, you cannot mimic this price action. You cannot mimic this price action with any indicator, nor you cannot mimic this price action with any expert advisor. This is me. This is my mind. I read charts correctly. And this time, I was reading it like this. This was the gap here. This is the gap actually, but this point is important because this was the swing low prior to this gap. This was the swing low, which is more important than this gap. This is more important because this is the true price action. This is caused by news. This isn't caused by any technical analysis, guys. This is caused by news, not by rational price movement. So this is, I know that this is important. I drew the line here. I put a Fibo. I look at my Camarilla and I waited for this. And what happened? Price got to this point perfectly. Bang! It shot it up. Unfortunately, I missed the trade by 3 pips, but if I placed my order around 60, I would have the trade. Now I would have been, I don't know, 15, 20 pips in profit. But the thing is, this is what differs good chart reading from bad chart reading. And I'm not saying that it works always the best, but most of the time it works, as you can see from my statements and from my Trade Explorer, which I posted on Forex Factory. And that Trade Explorer, I don't think it will be for too long, because now I see that many traders started to copy my trades and are asking me about stop loss and target price. Yeah, I can help you guys, but if you just copy my trades, then you will never learn. I'm trying to teach you, not to just copy and be good. We have Monday webinars for that, where I give you the analysis and my trades. On other days, I want you to see. I don't know which system you're using, which kind of trading you're using, but I want you to see I want you to know what you're trading. If you're Camarilla MACD student, then great. But if you trade the other system, the other method, maybe it won't be in agreement, and you will be angry at me if you lose a trade, right? So Trade Explorer I put there just to tell all other people who are actually trading and trying to teach other people that they should also put the Trade Explorer to see whether they are profitable or not. Because I know that there are many fake, and I just hate those fake traders who actually try to tell you that they are winner traders and they are just keep on losing. And then they try to teach someone how to trade. How can they teach someone if they are losing traders, if they lose the money? There can be months when we lose the money, but most of the time, after 6 months, whatever, we should be profitable. So the thing is how I do that. I always wait for a setup before I do the analysis. When I see the setup, I do the analysis. I apply Fibonacci's, trend lines, occasional divergence, and chart patterns. Of course, Camarilla MACD, historical movement of the price, and confluence zones. I wait patiently. I wait for pullbacks. If trade goes in contrary, it's usually a breakout trade. What happened today? I had a losing trade on Aussie, and my stop loss was something around 91.05. But actually 91.12 was the great support on Aussie. When I saw that this broke, what happened is it went down, then it went straight up, but then it went down again. So it usually, when I lose a trade, it's usually breakout trade. Because I know where stops are, I place a stop there, and probably most of the traders put stops around there, so it usually gives some momentum push in the opposite direction. But it doesn't matter. I covered it up with another trade. I had also euro-dollar buy, so I was buying euro-dollar on retracement. Now I'm waiting for a couple more trades. I'm waiting also for euro-CAD, which I was also mentioning. On my thread, I didn't have the time to pause the analysis, but when I saw that, no, it's still something around 41.80. But if I see that the price is moving rapidly above my confluence points, which is around 70 to 80, I need to say, then maybe it will break out. But still, we can see maybe some shorts from this region, but also from 42.40, where I also made a post about. So maybe I do the analysis tomorrow if the price doesn't get to the entry point today. So I always watch the daily close. This is important for me. And intraday analysis, I do it solely on 1 hour. Yeah, I can do it on 4 hour if I don't spot 1 hour movement. But then usually we need to wait for a bit of retracement. 1 hour is the great compromise between fast trade and patient trade. If you wait for 4 hours, then you might wait for too long. If you go on 15 minutes, then you're rushing in the trade. So that is, I do it on 1 hour time frame. That is my favorite time frame of choice for intraday setups, because that is the great compromise between rushing in a trade and patiently waiting for the trade. Advantages of using technical analysis. We are going with the trend. Guys, trend is your friend. Don't forget that. We are using market's momentum. So we are basically using what market is giving. I always say, if you chase your shadow, you will never catch it. That is like market. If you're chasing the market, you will not catch it. You need the market to come to you, to be patient, to patiently wait for market to come to you. If you wait market, it will come to you. You see, of all of those analyses, you can see that I am a patient trader. I wait the market to come to me. Occasionally I do a breakout trade, scalp trade, but most of the time I wait for the market to come to me. Orders have already been made, so we are following the big money. The big money is the case in Forex trading. Is the core of Forex trading. We are not market movers. Market movers are big banks, pension funds, hedge traders, hedge fund traders, institutional traders, big money, central banks, companies. Those are movers of the market. Now, again, the biggest advantage for me is that history repeats itself. History repeats itself. I will show you that. Disadvantages. It's subjective. Technical analysis is subjective. Have in mind that how I do the analysis, other people probably don't do that way. So it is subjective. The things can go wrong if there is news kicking in. Yes, we can lose a potential trade if there is news kicking in. Intraday analysis is harder than long-term analysis. It is, guys. Believe me, it is, just because it's easy to say euro-dollar will be 125 in 6 months. Well, if you say it today, you will forget it, what you said. Because if you say what will happen in 6 months, well, you know, most of the traders just don't care what will happen in 6 months. You all want to know what will happen today and what will happen tomorrow. And that is why we do these intraday analysis, session recaps, and so on. Because you want to make money. You don't want to be a politician, or I don't know, you don't work in ministry, so you just don't care whether the price will go there or there. If you trade intraday, if you trade intra-week, you are interested in near-term price action. What will happen in 6 months? Who knows? Maybe there will be an earthquake. and it will screw the technical analysis completely. So guys, if you want to trade properly, trade every day with a low risk. Or of course, if you're part-time traders, don't worry. I'm preparing a webinar next month about part-time trading and part-time trading system, if you don't have the time to go each day. Intraday analysis is harder. That's the point. Conclusion is, trend is your friend. So go with technical analysis, mostly trend analysis. Confluence is important. Confluence points are important because the bigger the confluence is, the safer your entry will be. History is the most important part of technical analysis. History repeats itself, and you need to be patient. Now I will show you the chart, a quick chart, to see how history repeats itself, and then we can, if you don't have any questions, we can call it a day. So guys, if you are looking at this chart, you can easily see the price action here. Look at the price. This is weekly, and this is, what is this, guys? Historical price action. 60.45 buy, 60.45 buy. Look at this, 63.11. Breakout of this, if GBP comes above this level, will be a breakout to the upside, because there you can see breakout, retest, continuation. Always pay attention to historical buyers and sellers. GBP Swissy, guys. GBP Swissy, guys. Let's find some historical buying and selling. Let's call it this zone. Why I'm waiting for this 51, 55? I still have my pending order there. Look at the history here. Look at the history here, guys. Look, breakout. Look, pullback, continuation. Breakout, again buying, again buying, again buying, again buying. History, buying, 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 buying. Look, is 51, 55, 60 region important? Yes, it is. So that is why you always should concentrate on finding historical price action. Now I told you one secret which can be crucial to your trading. Finding history of long and near-term buyers and sellers. I know that's not easy. Most of you want to trade stochastic crosses, but if you apply this in your technical analysis, that's great. It's not possible to create a robot because that is very subjective. What I see here, maybe a robot won't see. So you need to manually search for long-term, near-term, fresh-term, historical buyers and sellers. It's easy to trade manually, and robots can make mistakes. It's easier when your eyes and your mind comprehend it than if it's calculated by algorithms. It's just you feel safer for the trade. That is why I feel pretty safe about GBP Swissy, but unfortunately my trade was missed by 3 pips. If I was monitoring the trade, I would possibly enter at 58, but well, now the price is trying to break 51.70. So guys, this is what, if you want to do technical analysis, now I'm telling you one important thing. This is crucial, along with other confluence points or whatever you use for technical analysis. For my Camarilla MACD trading and analysis, history repeats itself. This is very important. This is very important. Confluence, trend, history, and patience. Without this, who knows what would happen? I just don't want to think about it. So guys, if you don't see any questions, we are already over the time. Thank you for listening to me. Thank you for your comments. Of course, I will be here with you on Monday. Chris will be also there with you with his live webinars. Thank you. I wish you a very pleasant week. Tomorrow we will do another analysis setup, possibly on EuroCAD, and we will see what will happen. Thank you, Claudio, for your comment. Of course, we are trying to make it good, and let's see if the price will listen to us. Thank you, and talk to you soon. Cheers.
Yeah, have a great weekend.